Well, Disney shareholders managed to fend off activist investor Nelson Peltz's effort to win seats in the entertainment giant's board. It's his second advance on the company in 2 years that he has been essentially defeated in. This ends what is likely to become the most expensive corporate proxy fight in history. An estimated $70 million was spent by various parties looking to secure votes, so both on the Disney side and on the Nelson Peltz side. Now it comes to the future, and it's interesting as the win goes to Iger that the stock sold off, closing down by about 3%. We've got Jamie Lumley, senior analyst at Third Bridge, for some insight. What do you make, Jamie, of that reaction? Even though the large majority of shareholders did vote for Iger's plan, that we did see some weakness in the stock today.
So coming out of the meeting today, what we know is that this battle is over, but the war might not be finished because Disney is definitely still under pressure. And there are a couple of key questions which have not been answered. Some people might have been looking at the shareholder meeting today, wondering if we get some clarity as to what the succession plans are for CEO. As of right now, there still is not a lot known about where things stand within that process. And there are also a couple of other areas where people have other questions, such as Parks and Experiences is going to be the subject of $60 billion in investment over the next decade. Where is that going? Disney still has not given too much clarity on that. And then also just how realistic the prospect is of getting to those streaming profitability numbers by the end of 2024.
It sounds like you're someone who's concerned about their ability to deliver both on growth, but also margins and profitability.
So when it comes to margins, that's really a big question for the streaming business, because for a long time, it has been growth at all costs, really seeing the scale of this business both at Disney and across the streaming landscape. But the big thing is companies like Disney talk about reaching double-digit margins, operating margins within this segment. Let's look at the story of Netflix. They're a company certainly viewed as a leader in this space, as the most subscribers compared to everybody else. It took them over a decade of being a streaming business to reach double-digit operating margins. So we think about Disney, if they're looking at just getting to break even this year, what does the road look like ahead to get there? There could be some challenges along the way.
Well, Netflix had to build that content library essentially from scratch, right? Disney is they've already got it. They've got a century worth of content that they can just put onto their streaming service.
So Disney definitely does have a history which is unrivaled in terms of the characters, the movies, the shows that they can rely on from the previous decades. But it's also worth keeping in mind that Disney's content entertainment business has not been firing on all cylinders. If we look at the box office performance of the last few years on some of their major films, if we look at the Marvels, for example, last fall, they haven't really been delivering some of these best-in-class results that historically Disney has seen. And there's also some of the older criticism of Disney is that while they do have excellent family content, they have great content for kids, they don't quite have the same broad appeal as a player like Netflix. Netflix has strove to be something for everyone, and while Disney definitely does have some properties with mass appeal, once you've gone through the Marvel Cinematic Universe, you've gone through Star Wars, some viewers will look at Disney Plus and think, there's not quite as much depth here as some other offerings. So while they do have a lot of history of content, they still are working to really build out that product to make sure it's robust, has mass appeal, and can scale to that profitable level.
Well, that's fine for my kids who just want to watch Frozen 700 times. In 1 year. But I do hear your point. On succession planning, I think that is the big wild card and the one obvious stumble, right? It didn't go well the first time around when Iger left. And really no indications, Iger, who is 73, and how many years he plans to be there for that turnaround.
It's a great point. If we look at Iger's tenure so far, he was initially only supposed to be here for 2 years. His contract was extended another 2, so he'll be here till at least 2026. And obviously, whenever they pick a CEO to transition, if it goes up to that timeline, we're not sure how much, training there will be, all that sort of stuff. But again, the big thing here is Disney has been fairly hush-hush about who is truly in the running here. There's been a lot of speculation about some of those internal leaders at the entertainment division, Parks and Experiences, ESPN, whether or not they're best suited for the job. And there's a lot of factors here. What we've been hearing at Thurbridge is that more likely than not, Disney will look to tap someone internally, look for someone within the Disney culture, as culture is something which is so central to this business. And particularly now that Nelson Peltz will not be on the board, his activist investor push was not successful in the shareholder meeting. It's more likely they will be leaning Disney than not, but there does remain a lot of uncertainty as to who's going to be in that CEO seat in a couple of years.